So let's go now to the next part of our discussion. We have types of audit procedures and audit evidence. So in this section, our references include the PSA 500 on audit evidence, PSA 505 on external confirmations, and PSA 520 on analytical procedures. So now let's revisit first the different types of audit procedures that we perform in an audit. Okay, and whether they are required to be performed or only warranted by circumstances. So let's start with the risk assessment procedures. So remember, we have repeatedly discussed this one. So when we talk about risk assessment procedures, so these are the procedures that an auditor performs to obtain understanding of the business of our client, including internal controls, and to identify and assess the risk of material misstatement. So normally we perform these procedures during the planning phase of the audit, including including at the studying and evaluation of internal controls. Now take note that this type of audit procedure, risk assessment procedure, are always required in every audit. We always perform risk assessment procedures in every audit. However, risk assessment procedures alone do not provide sufficient and appropriate evidence for us to base our audit opinion. So we'll always have to perform further audit procedures as an appropriate response to risk that we have identified in this audit procedure. So therefore, we have further audit procedures and we have two types. So we have the test of controls and we have the substantive test procedures. Now, test of controls, remember, are procedures that we perform to test the operating effectiveness of internal controls. So because remember in our discussion of a theoretical framework of auditing, if the controls of the client are effective, then it would most likely result to lower risks of material misstatement. And therefore, we can reduce the amount of work in that area whenever the client's internal control are effective. However, tests of controls are not always performed in every audit. Performance of test of controls would be warranted by circumstances. So it's conditional. So when do we perform test of controls in audit? We perform test of controls under two conditions or situations. One, when the auditor intends to rely on the client's internal control to reduce the amount of our work when it comes to substantive test procedures. So meaning to say we can only reduce the amount of substantive tests only if the client's controls are effective. And to determine whether the client's controls are effective, we have to perform tests of control. So that is why if we want to rely on the related control to reduce our work, then we have to test the control of the client. Okay? Now, another situation wherein we will be performing task of control would be when substantive procedures alone do not provide sufficient and appropriate audit evidence. So like for example, there are process or areas in the client's financial statements or financial reporting process where there would be no available evidence. So for us to perform substantive test procedures too, then we can also rely in part from the test of controls or result of test of controls. So these are the two situations wherein we perform test of controls. So remember that. So number one, when we intend to rely on the internal control of the client, and number two, when substantive procedures alone do not provide for sufficient and appropriate audit evidence. And then finally, we have another further audit procedure. We have substantive test procedure. So substantive test procedures are procedures that we perform as auditors to detect material misstatements at the assertion level. So this is the part wherein we actively search for potential material misstatements in the financial statements of our client. So by obtaining various audit evidence, so like inquiry, inspection, analytical procedures, observation, confirmation, recalculation. So to determine whether the financial statements are free from material misstatements. So there are two types of substantive test procedures. We have number one, the substantive analytical procedures. So the substantive analytical procedures are less reliable in nature. So compared to its counterpart, test of details. So that is why the performance of substantive analytical procedures are also warranted by circumstances. We normally perform substantive analytical procedures when there is lower risk of material misstatement. So, but if there's high risk of material misstatement, so we normally don't rely on substantive analytical procedures, but rather on the test of details. So test of details, this is always required because this will be the main basis of the audit opinion, the conclusion that we will issue in the course of the audit. Now, there are also some procedures that are considered or used as both test of controls and substantive test. So those audit procedures are called dual purpose test. No? So dual purpose tests are those procedures that satisfy both the objectives of test of controls and substantive test. Now, for example, when we perform our inventory procedures at year end, when we observe the counting of inventory of the client, so the part wherein we observe the process of the client's personnel conducting the count, so it will be part of our test of control over the client's account procedure. And when we perform some tests, like for example, test counts during the same uh, observation of inventory count procedure, then that would constitute substantive test procedures naman. So in that case, that audit procedure would be considered as a dual purpose test. So since it both satisfies the objective of test of control and substantive test. Then the different types of audit evidence that we can obtain in an audit. So we have inquiry, inspection, so which could be both inspection of documents or physical examination of assets. So we have observation, analytical procedures, confirmation, recalculation, and reperformance. So let's discuss one by one. So starting with inquiry. So inquiry consists of seeking information of knowledgeable persons, whether about financial or non-financial matter, so throughout the entity or outside the entity. So inquiry is the type of audit evidence that we use extensively in audit. It often complements the other audit procedures or other audit evidence that we obtain. Okay? And although inquiry is the most extensively used procedure in audit, it does not on itself provide sufficient and appropriate evidence. So usually this is only our starting point. So of course, before we obtain another type of audit evidence or before we dig deeper to the information that we want to document, so of course we start by asking question. So that's why this is the starting point of our audit procedure. And this is also one of the first audit evidence that we obtain when we perform our procedure. Okay? So that is why we perform inquiry or we obtain inquiry complementary with obtaining other audit evidence, such as inspection and observation of documents. So after we ask questions from the client. Okay? So however, there are situations or circumstances where inquiry alone is the only available procedure. So like for example, in determining management intent, then we have no other evidence than to inquire about that intent from the client. So in that case, our corroborating evidence or supplementing evidence would be the subsequent event. So whether, for example, the client carried out or stayed true to the intent that they have mentioned to us when we inquired to them in the first place, or during the first time that we ask them about that intent. So we will observe what will happen in the future. So whether they will carry out that stated intention in the process. Okay, so that's how we use inquiry as audit evidence to those circumstances or situation that is the only available procedure or evidence. And then there are also different types of inquiry. So inquiry can be very formal, like for example, a formal interview wherein we set an appointment with the client personnel. We document the minutes of meetings, or sometimes we record the discussion with the client. To informal oral inquiries. So like for example, we have follow-up questions, or we are performing another type of audit procedure, and we start our session with the client by inquiring matters from them first before we perform our another planned audit procedure. However, when it comes to critical oral responses, for example, there are important information that we need to document, we often obtain written representation from the client. So written representation is a type of audit evidence wherein the client prepare a formal response in writing about certain assertions in the financial statements. So especially if there are no other audit evidence available to support that particular representation from the client. So next, another type of audit evidence that we obtain, we have inspection. And again, as mentioned earlier, it consists of inspection of records or documents or physical examination of assets. So both are forms of inspection. So we inspect records or documents in connection to obtaining evidence about the reliability and sometimes effectiveness of internal control. Like for example, we want to obtain evidence about a process being performed by the client. So we can do so by inspecting the related document being used in that process. So let's say credit approval. So if you want to test the reliability of credit approval process, so we have to inspect the document that evidences the credit approval of a customer as part of that process. We can also use inspection to provide evidence on existence of intangible assets and financial instruments. So we know that these assets do not have physical substance. So the only evidence available about them or pertaining to them are titles, legal papers, contracts. So we also inspect those type of documents. Now, when it comes to physical examination of assets, so we use this evidence to provide the evidence on existence of the asset of the client. Like for example, property, plant, and equipment, an item of PPE or inventory. So to examine the existence of those assets, so we can use physical examination of those particular assets. So, however, physical examination of asset would least likely support the rights and obligations. So because it's possible that, let's say the fixed asset, it's there, but it is only, let's say, consigned to the client. So therefore, the client does not own or have the right over that particular asset, even if it is situated in the premises of the client. And another thing about inspection of asset is that it is normally done together with observation. So that is why inspection and observation go hand in hand when we obtain those types of evidence. So another important concept related to inspection is that the objective being addressed would depend on the direction of testing. Okay, I think we mentioned this earlier in one of our discussion. So if the direction is coming from the accounting records, going to the source document, so we call that vouching. So vouching supports the assertion of existence or occurrence, but not completeness. Because when you start from the accounting records, what you can get or satisfy there is whether that item recorded in the accounting records would be supported by a source document. And therefore, that item is existing or that transaction has actually occurred. But if, let's say, the list is incomplete, okay, for example, an item is not included in the accounting record, then you will not be able to identify that missing item if you start from the accounting record. So you can only identify that missing item if you started from the source document and trace it back to the accounting record. So let's say a particular source document is not listed among the items in the accounting record. You will be able to realize that if you start from the source document. So that is why vouching or from accounting record to source document would be an effective procedure to validate existence or occurrence but not completeness. So conversely, if we start from the source document, so going back to the accounting record, so we call that tracing. And the objective being satisfied there is completeness. So because if you start from the source document, you will note whether that item is recorded in the accounting records or not. So therefore, if it's not recorded, then the accounting record is incomplete. Okay, but you cannot satisfy the objective of existence or occurrence. So because let's say the source item is not existing at all, but it is written in the accounting record, you will not be able to detect that. So because in the first place, your starting point do not include the matter that you want to test. So which is the fictitious item listed in the accounting record. So that's why it is said that tracing is effective for validating completeness, but not existence or occurrence. So next, another audit evidence here, we have observation. So observation consists of looking at a process or procedure that is being performed by others. Like for example, the personnel of the client. So performing a certain process. Now, it provides audit evidence about performance of a process, as we have mentioned, or procedure, but it is subject to certain limitations. So number one, it is limited to the point in time at which our observation took place. So that is why, for example, we observe the client's process this year. So it will not provide evidence that the performance or level of performance of that process will be similar or the same in the following year or at a different time period. So therefore, to obtain evidence about the level of performance on that another time period, so you have to reperform that observation procedure. So another limitation is the fact that the act of being observed may somehow affect how the process procedure is performed. So especially if the personnel is aware that he or she is being observed, so it might affect the level of performance that the employee or personnel is showing. So we have to be mindful of that when we perform or obtain this type of audit evidence. So another type of audit evidence would be the analytical procedures. So analytical procedures consist of evaluation of financial information by studying plausible or another equivalent term, predictable relationships among items or different items, whether financial or non-financial in nature. So examples of analytical procedures include evaluation of identified fluctuations. Now, like for example, we compare the information this year and last year. So we get the change or difference on that item last year and this year. And we evaluate those that have significant differences or fluctuation. Okay? And also evaluating relationships that are inconsistent with other relevant information. So like for example, you compare one item in the financial statement with other connected item in the financial statement, and if the movement or the information is not consistent with the expectation of the auditor, so that could give light to possible problem or misstatements in the financial statements of our clients. Now, when do we perform analytical procedures? So analytical procedures are performed thrice in an audit. So first, during planning phase. So second, during substantive test procedures. And last, or the third one, during the final review stage. So however, the purpose or the objectives are different on each phase of this audit or audit process. Now, like for example, during planning, our objective in performing analytical procedures would be to enhance our understanding of the business of the client and to identify and assess risk of material misstatement. So during substantive test, our objective of performing analytical procedures would be to detect material misstatements at the assertion level. While when we perform analytical procedures at final review stage, our objective is to determine whether the findings or the evidence that we have obtained support the conclusion that we have arrived at the end of our audit. So same nature of evidence or procedure, but different purposes. And take note also that analytical procedures are required on certain phases of the audit. So analytical procedures are required to be performed during the planning and the final review stage. Okay, so this one, remember, this is a very important concept in performing or obtaining analytical procedures as an audit evidence. So during planning and final review stage, analytical procedures are required to be performed. So during planning, analytical procedures performed are considered as preliminary analytical review or preliminary analytical procedures. So during the substantive test, it's called substantive analytical procedures. And during the final review stage, it's called final analytical review or concluding analytical review. Okay? So, and then again, they are required during planning and final review stage. How about during substantive test? So again, it's warranted by circumstances. Because remember in our discussion in the previous slide or slides, what happened is that it's considered as less reliable compared to its counterpart test of details. So that's why we normally perform substantive analytical review or procedures if there is lower risk of material misstatement. So what are the steps in performing analytical procedures? So the first step is for us to develop an expectation. Now, for example, based on our understanding of the business of the client, so how much level of fluctuation do we expect? Okay, for example, based from last year figure, how much do you expect that particular item in the financial statements would move? So that will be the basis of our evaluation. So whether the movement is normal or abnormal, no, or unusual. Okay, or for example, if we use, let's say, ratio analysis, which is another example of analytical procedure. So based on the ratio of that item in the financial statement compared to the other item of financial statement, so how much do we expect that another item in the financial statement of the client? Like for example, let's say the interest rate on the notes payable or loans payable of the client is 10%, then we develop an expectation of how much the interest expense of the client for the year, given that the level of its loan is this much. So that is how we develop our expectation. And then we set our materiality. So because our expectation could have a difference from the actual amount. Now let's say we expect that the movement in this account will be 25%. Okay. So therefore, if the amount of movement is more than 25%, then we have to investigate it. Okay. Or it could be an amount. Now let's say the movement in this item would be 100,000 pesos. So if it's above that amount or threshold, then we have to investigate. Okay. So therefore, we compare the actual item from our expectation, like what we have just explained, and we investigate significant differences. So those that go beyond the threshold, our expectation, then we have to investigate. Okay, so because guys, analytical procedures or our findings based on analytical procedures are not conclusive in nature. If, for example, the movement or the amount is significantly different from the actual amount, that does not necessarily mean that the financial statements are materially misstated. So normally, it's only an indication that there might be a problem or there might be a parameter that we haven't considered. So therefore, we have to investigate further what caused the significant difference. So based on our initial expectation. Okay? And another thing is that there are limitations in using analytical procedures. So we can only use analytical procedures in certain situation. Okay, so meaning to say analytical procedures are more effective in a certain situation compared to the other. So example, these are generalization about plausible or predictable relationship. Usually, the result of analytical procedures are more reliable if we use it on a stable environment compared to dynamic or volatile environment. So because it's easier to predict when the environment is stable compared when the environment is dynamic or volatile. So it follows the result of our analytical procedures would be more reliable if the environment is stable. So another is that analytical procedures are normally more reliable or effective or predictable in uh, relation to income statement accounts or statement of comprehensive income accounts compared to balance sheet accounts or statement of financial position accounts generally. Now, like for example, if we want to predict, let's say, the movement of sales, so we can use a pattern from the last year's operation. Okay, so the pattern of sales or the nature of the client's product or business. So let's say the client is selling fruits or vegetables or seafoods. So therefore, if it's the season of that particular product of the client, then we can expect higher sales during those months or during those period. Okay. So compared, for example, if you want to predict the balance of cash of the client at a certain point in time, it will be very difficult because there will be a lot of factors that you have to consider in determining the level of balance or amount of that balance sheet item. So it's easier to predict when we or in relation to income statement accounts compared to balance sheet accounts. Okay, then finally, it's easier to predict when it comes to factual items, so compared to judgment and estimate. So here are the generalization related to performance of analytical procedures. So finally, limitations of analytical procedure. So subjective in nature. So there's no established guidelines or procedure or rule why let's say a certain ratio is good or bad. No, if for example we are using ratio analysis as analytical procedure. So another limitation of analytical procedure is that it is difficult to determine so whether significant fluctuations or deviations are misstatements or legitimate change, no, or random change in the accounts or items. And finally, na-mention na rin earlier, is that it's only a circumstantial evidence. So meaning to say, it can lead you to potential misstatement based on your further investigation. So, but based on the analytical procedures alone, so you cannot tell with certainty whether the significant difference or deviation are misstatements or not. Okay? So that is why usually when we perform analytical procedures, it would only lead you not to determining whether you need to perform further audit procedures or further investigation. So rather than direct detection of material misstatement.